Hi, this is Claus Vogt for Money and Markets TV. The stock market is considered a leading economic indicator, so I'm interpreting three recent developments in the stock market as warning signs for the general economy. First, we have a negative divergence in the banking sector. One of the tools that tactical analysts use to evaluate the market is the concept of uniformity and divergence. During a healthy bull market, more or less all sectors are uniformly positive, and they are uniformly negative during a strong bear market. But when a bull market starts to break down, suddenly we see some divergences. One or more sectors aren't participating in the rally, even if the economic news is still good. And that's exactly what's happening now in the banking sector. If we look at a chart of the KBW Bank Index versus the broader S&P 500, we can see that divergence more clearly. Both indexes hit a peak in April 2010, but since then, the S&P 500 has made new highs. The KBW index also rose, but not as steeply as the broader index. And since mid-February, it has slid more than 12%. To me, this looks like a topping formation. That's a very ominous sign for the financial stocks, and it could signal that the cyclical market rally that started in March of 2009 has entered its last inning. It's also instructive to look at banking stocks in combination with 10-year treasury yields. They dropped roughly 60 basis points over the past 3 months as the banking sector experienced its double-digit decline. That's a very rare combination, and in the past, it has signaled either a recession, a financial crisis, or both. The second bearish message I'm seeing comes from the S&P 500 itself. At the end of April, it looked like it was about to break out to the upside, along with many other domestic and global indexes. But 4 weeks later, those markets have fallen back to earth, meaning the breakout attempt has failed. A failed breakout is as important a technical indicator as a successful one, while a successful breakout indicates a continuation of the bull move. A failed breakout indicates severe weakness. It's a clear warning sign that the bull market is in jeopardy. Another indicator I look at is the price momentum oscillator, or PMO. As you can see from the middle section of this chart, it's still in neutral territory, meaning that there's lots of room for further downside movement in the short term. And longer term, momentum indicators also exhibit negative divergences. All these signs tell me that we are seeing a major top in the market here. But I don't just look at the US market, I'm seeing negative divergences on a global scale. Most emerging markets are showing well-formed topping formations, and their charts are showing clear relative weakness. This is another bad sign. Emerging markets were the first to bottom out during the last bear market, and now they seem to be leading the way into the next bear. For these reasons, now is not the time to be in stocks. The market is at least 40% overvalued, and the macroeconomic picture is deteriorating rapidly. To profit from the coming downside move, you might consider a broad inverse ETF, such as the ProShares Short S&P 500, ticker symbol SH. I'd recommend trying to buy it below $40.80 a share and setting a stop loss at $38.80. If you want to bet against the Nasdaq Composite, buy the ProShares Short QQQ at around $32.50 and set your stop loss at 31. I'm Claus Vogt for Money and Markets TV. Thanks for watching.